Over the past year, the S&P 500 has been on an absolute tear. We can see SPY, the S&P 500 ETF, trading at $551.46, and over the past year, up 24.26%, and year to date, up over 16%. So when we look at a heat map of the S&P 500 during this time, we see green pretty much everywhere we look. But then if we come over here and look at real estate investment trust right here, we can see there's still a whole lot of red in this sector. And out of all the different sectors in the S&P 500, REITs have probably fallen behind the most. And a lot of this has to do with the current interest rate environment we're operating under, but I believe this creates opportunities. And one of those potential opportunities for income-oriented investors is going to be EPR properties, stock ticker EPR, trading at $41.48. Now, like most REITs, they are down by a decent bit over the past year, down by about 12.19%. But before we talk about anything else about this company, I want to look at it from a dividend perspective. Let's go ahead and jump over to my dividend breakdown sheet, come up here and plug in EPR and hit enter. And all this data will load in. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. Now, the first thing I want to point out about EPR right here, this company has a massive starting dividend yield. It's sitting at about 8.24%. So they pay out really large dividend payments. Now, if we come down here and look at the yearly dividend payment history, it's a little bit interesting. We can see for a while here from 2014 or even 2013 to 2019, the dividend growth was actually pretty good for a real estate investment trust. And then 2020 hit and that dividend was reduced by a pretty large amount, and that stayed true in 2021. But since then, they have started recovering that dividend payment, and the dividend payment right now for the year is sitting at about $3.42, which is pretty much where it was at in 2014. So not ideal that they had to cut their dividend payments in 2020. Definitely not something I typically like to see out of stocks that I'm considering. Now we have to keep in mind, this is a real estate investment trust, so I'm not going to pay attention to things like free cash flow payout ratio or even the free cash flow growth from this company. And I'm actually not going to pay attention to the payout ratio. The payout ratio is not a good way to tell if those dividend payments are safe when you're looking at a real estate investment trust. Instead, what we need to look at is the AFFO payout ratio. So if we jump over to Seeking Alpha and click on dividends, go to dividend safety and scroll down. What we can see, if we come up here, we have an AFFO payout ratio forward looking of about 70.7% and an AFFO payout ratio for the trailing 12 months of about 66%. So in reality, these dividend payments as of right now, based off their funds from operation, look pretty healthy. So it's important to remember, when you're looking at a REIT, you don't want to look at the free cash flow payout ratio or even the earnings payout ratio. It needs to be AFFO payout ratio or the FFO payout ratio. That's how you judge their safety. So we've touched on the dividend a bit, but there's still more we have to understand. If we look at the dividend history on Seeking Alpha, one of the things we can see, this is actually a company that pays out dividends every single month. That's dividends on a monthly basis. And keep in mind, they have a massive starting dividend yield of sitting at about 8%. So I know that's exciting for a lot of people. You get paid every single month, and those are pretty large dividend payments. And as of right now, they do look relatively safe. And over the past few quarters, they actually have been growing a little bit since they cut their dividend payment. So for income investors who consider themselves a little bit more aggressive, this one could be potentially a good play. And I think based off the things we've talked about so far, you should be a little bit excited about this. But we still haven't even touched on EPR properties. What are they? What do they do? Well, EPR properties has built itself as the diversified experiential REIT. So what I want to do is touch on their tenant base, talk about this for a moment, and we can actually see this in their investors presentation. If we go ahead and blow this up, let's go ahead and jump over to the 6th slide. Here we can see their Q1 experiential portfolio update. So the majority of their tenants kind of operate in these subsectors like eat and play, attractions and cultural, fitness and wellness, ski resorts, and experiential lodging. If we jump over to the 12th slide, we can see there's an estimated $100 billion addressable market for this company. If we look at the target experiential property types that they look at, again, some of them are similar to what we just saw: eat and play, gaming, experiential lodging, ski. We have attractions, and then we have cultural. We have things like museums, zoos, aquariums. We even have live concert venues as well, and e-gaming venues. Then we have fitness and wellness. So this is definitely not your typical REIT. The tenant base it has is somewhat unique. And if we jump over to the 21st slide, we can see their portfolio in a little more detail. We can see theaters make up the majority of their portfolio as of right now, sitting at about 37%. Now, this is something I'm not necessarily a huge fan of, but we can actually see they're not a fan of it either. If we look at their strategic focus, they're planning on reducing the size of their theater tenants. We can see eat and play. They have 58 different properties, and this makes up around 24% of their adjusted EBITDA. Then we have attractions at 11%. We have ski, experiential lodging, gaming, fitness and wellness, and then we have cultural making up a very small amount. They just have one property making up about 1% of the portfolio. So the experiential portfolio makes up about 93% of their tenant base, but then we can see they actually have a relatively small education portfolio, making up around 7% of their adjusted EBITDA. But the plan is actually to reduce this position. As we can see, they're going to reduce early childhood education and private school positions. So really the main focus for this company moving forward is going to be these property types right here, the experiential portfolio minus the theaters. Now what's interesting about this is if we dig into the investor's presentation a little bit more, they actually try to sell us on theaters a little bit more. So I'm not quite sure why they're doing this. It's like they're trying to sell us on theaters even though they've told us they're planning on reducing this position. And it makes sense why they're wanting to reduce this position. If we look at the annual US box office revenue, there's been a massive drop off since 2020, which we all know, and it still hasn't even recovered to its 2000 levels. So this definitely took a huge toll on EPR, and if we actually go back to Seeking Alpha, we can see over the past 5 years, the company's down about 45%. But if we look at where they were trading pre-2020, this company was trading as high as around $72 per share or even close to around $78 per share. So it is way off from its all-time highs. It is significantly lower than it was pre-2020. But here's what's really interesting about this. If we jump over to the financial statements, let's look at the AFF growth over the past decade. If we scroll down on the income statement, and right here, it looks like we can see adjusted funds from operation per share. We can see pre-2020, December of 2019, adjusted funds from operation was sitting at about $5.51. Now obviously there was a huge drop off in 2020 and 2021 and it took a while to recover, but we can see they're close to recovering to those pre-2020 levels. But despite this, they're still down nearly 40% from their pre-2020 levels. So adjusted funds from operation has recovered, but the stock price has not recovered. If you're someone looking for opportunity, this is a good sign. Now, obviously, like we already know, a huge reason behind the share price not recovering is going to be the high interest rate environment that we're currently operating under. Investors love getting risk-free returns, and right now with interest rates, they can probably get a 5% risk-free return if they look in the right places. But again, this company has a massive starting dividend yield sitting at 8.24%. Now, if we go over to the fourth slide on the investor's presentation, we can get some Q1 2024 headlines. First off, they talk about their investment pipeline. Q1 2024 investment spending was about $85.7 million, including a $33.4 million acquisition of Water Safari Resort in Old Forge, New York, and then a $4.7 million acquisition of land for 2 karting developments. We can also see they're claiming they have a pretty strong liquidity position. They also increased their monthly dividend payout by about 3.6%. That's a really nice dividend hike for a company that already has a starting yield of over 8%. Again, something else to like about the dividend, and then we can see they confirmed their 2024 guidance. If we jump over to the fifth slide, we can see they basically give a theater update. Again, they're pushing their theaters and the tenants in their theaters, even though they're wanting to reduce this position long term. And then if we jump over to the 10th slide, they talk about the experience economy. And this has seen a really strong recovery since 2020. We can see the dip right here, but it's back and above its pre-2020 levels. Now, this obviously isn't true for theaters like we've already touched on, but a lot of things have pushed the experience economy even higher. We can see we have things like Topgolf, we have water slides, we have ski resorts. EPR is bullish on all of these tenant types. So it makes sense why EPR took such a large decline in 2020. That was a really difficult time to own experiential real estate. But since then, the adjusted funds from operation has recovered, but the share price has not recovered. The company has a safe, large, growing dividend payment that's paid out every single month. But despite this, the company's actually close to its 52-week low, trading at $41.48 when the 52-week low is about $39.66. So does this create opportunity, and is the company trading at a good valuation? But to answer that question, we're gonna have to jump into my REIT valuation spreadsheet. If we come over here on the spreadsheet, we'll plug in EPR and hit enter, and this data will load in. Now, something you have to know about this company, if we come down here, the beta is very high. It's sitting close to 1.7, so you're typically going to see quite a bit of volatility with this company, which a lot of people, especially income investors, aren't going to like that, and that's completely understandable. This is definitely a more aggressive income play. But if you move forward, let's go ahead and look at the AFFO multiples valuation. And basically the idea behind this is we should be able to value a company based on how the market is valuing companies that are similar in structure. So we can see we don't have perfect comparables in this example because EPR is pretty unique. But Vici Properties, it's probably a fair comparable. Price to AFFO of 12.34, NNN 12.64, and Outfront Media 8.5. So the average P to AFFO ratio for these companies is sitting at about 11.16, but EPR is sitting at 8.62. So if we applied the same average price to AFFO to EPR, we'd come to an intrinsic value of $53.70, which is quite a bit higher than that current trading price for this company. Now, the next valuation that I want to look at is a pretty unique one, and I really like it for real estate investment trust, and it's the historical price to FFO model. And basically what this does is it values the company based on how it's been trading historically. So right here, you can see we have the historical price per share for the company and the price per share as of right now. And then we have historical FFO per share for the company. So what we do is we divide this price per share by the historical FFO on a yearly basis, and we get historical price to FFO over the past decade. And basically we can see the trends. We can see the averages for where it's been over the past decade. And the average price to FFO for this company over the last 10 years is sitting at about 13.48. But look at where it is right now. It's sitting at 8.35. So even compared to how this company has traded historically speaking, it's significantly undervalued. Now again, we absolutely have to keep in mind, 10 years ago, the interest rate environment was completely different, which undoubtedly plays a large role in this good valuation that we're seeing. Let's keep moving forward and look at our last valuation, which is going to be the dividend discount model. And this values a company based on how much they pay out in dividends and how much that dividend is increasing over time. Now we have to keep in mind, when performing this model, they did cut their dividend in 2020 and 2021. Something I don't necessarily like, obviously, as a dividend investor, but that dividend has recovered quite a bit, and they're now paying out $3.42 per share. And we can see if we assume a dividend growth rate of just 0.5% and a discount rate of 8.5%, moving forward, we come to a dividend discount model price per share of $42.96, which is just a little bit above that current trading price. But keep in mind, this most recent dividend hike they saw was above 3%. Is that sustainable moving forward? I actually think it may be possible, but because of the dividend cut, I don't want to make the assumption those 3% dividend growth rates will be the normal moving forward. But even with that low dividend growth rate, it appears to be a pretty good valuation because of those big dividend payments. So when we jump over to the output tab, we can see the AFFO multiples at 53.70, dividend discount at about 43, and keep in mind, the historical price to FFO model isn't showing up here because it doesn't give us a specific price per share, but even then we found that the company was undervalued, so when we average these two together, we come to an intrinsic value of $48.33, which is above that current trading price. It's a difference of about 14%. So with a 10% margin of safety, it looks like our acceptable buy price is about $43.50, giving us a buy signal. With a 20% margin of safety, the acceptable buy price would be around $38.67, which it was pretty close to when it was right at its 52-week low. But overall, this company appears to be trading at a pretty decent value, pays out monthly dividends, has massive dividend payments, it's growing those dividend payments, and the dividend appears to be safe. Now, as for me, I'm someone looking to live off dividend payments, but I have a long time horizon. I'm looking for companies that can rapidly increase their dividend payouts over time and where I should see a lot of share price appreciation as well. So this company doesn't necessarily fall into what I'm looking for out of my investments right now. But for people looking for immediate dividend income, people who are more aggressive income investors, this could be a good opportunity for you to look at. And with the Federal Reserve recently claiming that we could see our first interest rate deduction by the end of the year, we could see REITs really start to recover. But regardless, the good news is, even if we don't see interest rates move for a little bit longer, you get to sit back and collect a very nice large dividend yield while you wait. But there you go, there's an analysis on EPR property, stock ticker EPR. Go ahead and let me know what you think of this company in the comments down below. And like always, if you'd like to be able to download any of my spreadsheets and also get access to the ticker data add-on in Google Sheets that allows you to automatically import stock financials straight into your spreadsheet, then you can head over to tickerdata.com at the link in the description. So with all that being said, thank you guys so much for watching, and please don't forget to like and subscribe to the channel.